Welcome to Stockwatch with me, Ndauleng Lechela. And joining me to unpack your stock-related questions today are Jean Pierre Verster from Protea Capital Management and Ricus from PSG Hole-in-One Ruimsig. Be sure to send your questions through via email to stockwatch@bdtv.co.za, via SMS on 41392 or on X at Business Day TV using the hashtag Stockwatch. Gents, thank you so much for your time this evening. Maybe let's start with precious metals. Safe haven demand seems to have somewhat paused, Ricus, with gold, silver, PGMs in the red. What's behind that? Are investors just taking a wait-and-see approach as we deal with some of those geopolitical tensions over in the Middle East, with talks between Iran and the US ongoing? Of course, we also have those Fed minutes coming out tomorrow.
Yeah, I think as you said, the politics in Iran-US is probably playing a part in that. I think there's also a general feeling, specifically amongst US investors, that that the interest rate policy might be more dovish than previously thought. So that's helping a little bit as well. But yeah, not anything specific that I can see.
What I also noticed, JP, was that European markets were in the green, whereas we are seeing red screens over in the US and here at home. What's fueling the positive sentiment over in Europe?
Well, it's more a case of the US having been closed yesterday because of President's Day, so they effectively need
to
catch up. Make up a day. There were some results in Europe that looked a bit better than some of the US results that have come out. But if you look on a two-day basis, the difference is not as large as it looks on one day, just because the US was closed yesterday. So it's a change since Friday, while the European markets today are a change since yesterday.
All right, let's get into some of those earnings out today, starting with BHP. The shares hit a record high. This as the group, of course, posted profits that topped expectations, really fueled by a strong showing from copper operations as prices for the red metal continued to surge. Just your analysis of those numbers, Ricus.
Yeah, I mean, not much to say, as you've said. Above expectations, copper really came to the party. I think the market likes the silver deal that they're doing with wheat, precious metals as well.
It's also interesting to see the kind of change of tone when it comes to acquisitions, JP.
Yes, so they're really focusing on copper and putting capex in the ground to expand their copper portfolio rather than spending money on M&A and doing other things. They did also do that streaming deal with Ricus on the silver byproducts that they get from one of their mines, which brings them in very nice capital. And again, they need to make it clear to investors that they will be disciplined because of this capital that they are getting, and that they won't go for big M&A if it doesn't make sense. But rather focus on copper, which is now more than half the profits, while historically one normally associated iron ore with BHP Billiton.
And what's
so some potash, some still making coal, still significant iron ore, but going forward, BHP will increasingly become a copper play.
What's playing out when looking at the iron ore business, JP? Are we just seeing waning demand over in China?
That's mostly it, yes. So we've spoken quite a lot on this program about commodity prices going through the roof, whether it's precious metals or copper, and even some other metals recently have done very nicely, but not iron ore. And to a large extent, that is because the primary market for iron ore is China. Goes into steel production, which goes into property development, mostly high-rise residential buildings that need a lot of steel. And Chinese property market has been in a slump for an extended period now. So that's why there's a school of thought that thinks that maybe India can take over from China, but it doesn't look like the intensity of steel use is picking up the slack in India to the extent that it's slowing down in China. And that's why of all the major commodities, you can see these major mining companies saying that strategically they want to decrease their exposure to iron ore, increase to the likes of copper. And it's because they also expect that that the iron ore price rather, might not do as well as the other commodities, looking at what is happening in the China property space.
And keeping that in mind, Ricus, those dynamics at play when looking at the commodity market and sentiment around iron ore, what does this suggest about sentiment when it comes to China's economy? It does seem like China's economy is not growing as fast as economists, analysts had expected.
Yeah, I think that's been going on for a long time. And never mind growing, they're actually in a deflationary cycle. As you can see by the consumer spend, there was a productivity report that was released a day or two ago, and that's looking bleak. So there's lots of talk in the Chinese government about supporting both consumer spend and also stimulating some parts of the economy, specifically related to AI and tech, but we're not seeing numbers coming through yet. So the mood remains quite pessimistic on Chinese growth, and a lot of that has to do with personal consumption. As Jean Pierre said, a lot of Chinese investors, or the Chinese public, had property as a big part of their investment portfolio, and that's really in a slump. And if you see your major assets not increasing in price, it doesn't really make you that optimistic and towards spending on other stuff.
And what's your sentiment looking like when it comes to China and growth prospects on that front? Ricus, they're talking about stimulus. We've also seen, China really come forth when it comes to AI. We've seen quite a few new listings when it comes to the tech sector as well. Not necessarily big, but we are seeing a lot of listings coming through on that front when it comes to the tech sector as well.
Yes, look, it's Chinese New Year today, the year of the horse. So for like 3 days, there's going to be Hong Kong is going to be closed, and there's going to be little activity in those Asian markets. But when the Chinese come back, then we'll see if maybe they got some positive consumer sentiment from going back home and having a meal with their parents. Although chances are it will not, because the parents will be moaning with them for the youngsters about why aren't they having children, because there were record low births in the past year in China. If you have a decreasing population, you've got deflation, which means you've got less aggregate demand. That's not good for an economy. And to your point, the response might be stimulus. But the government so far hasn't announced anything like that. So yes, we've seen some new listings. Most of them are companies that came back from being listed outside of China and outside of Hong Kong to being listed in Hong Kong, which is now part of China. But it's not really new capital formation, new private companies that are listing. It's rather a homecoming of overseas listings coming back under the control of the Chinese regulators, which is what they prefer. So yes, in the short term, it doesn't look great for the consumer side of the Chinese economy. The tech shares were bombed out up until about a year ago. And as usually is the case, markets turn before economies turn. So they've had mostly a very nice year, which means that looking forward, maybe there's a recovery around the corner, but not across the whole Chinese economy. The consumer side of the economy might be under pressure for a while still.
All right, let's bring it back home. Looking at Afrimat's update, investors not liking that at all. I think the share price was down 7% when markets closed. What's going on there? It seems like Afrimat has had to contend with issues that are beyond its control. Of course, a tough macroeconomic environment, Ricus.
Precisely that. I think management's indicated that they've done what they can and they've executed what they can. But if ArcelorMittal isn't making iron and you can't export the way you want to, and infrastructure spend is not coming through, there's not much Afrimat can do apart from trying to run their operations as efficiently as possible, which I think they've done. But that doesn't mean you're going to get an increase in earnings. I think the market itself was hoping for better commentary, and they
Yeah.
haven't got that, which is why I think the share price, it's been having a small rally, sort of above the 40 rand level, and it's just gave all of that back on today's announcement.
Let's get your thoughts around that update, JP. You know, when we talk about Afrimat, even when results or earnings look tepid, there's always a talk about backing the management and that the management knows what it's doing. And a viewer here asking off of the back of the sell-off we saw today whether they should hold or sell their shares.
Well, I can say that I'm holding my shares. We own some Afrimat in our funds. And yes, the management team is a very good management team, but at some point in time when the seas are rough, any boat, even with a very good captain, is going to take on some water. So they aren't sinking yet, but they have taken on some water. They need to get the old Lafarge business to profitable as soon as possible. They said hopefully that will come in the next 6 months or so. They're hopeful that the manganese and chrome smelters that will be switched on will bring back some demand for some of their products. We need some building activity in the country, so the aggregates business can get a leg up. And then we hope that the iron ore price will stay relatively firm to assist them there, even though the strong rand is a headwind for them. So yes, I would hold still, because I don't think the business is in trouble. But as with a lot of, call it, South African exposed companies, SAE companies, we do need some domestic economic growth before these companies whose share prices have been under enormous pressure for a number of years now can see a pickup in activity and therefore a pickup in their share prices. And you'll need to hold your breath while that happens, and maybe you'll go a little bit blue in the face until it happens.
All right. Let's start off with what's playing out when it comes to the Warner Brothers acquisition. It doesn't seem like that deal is going away anytime soon. When we think that, hey, Warner Brothers is going with Netflix, here we are again, and it seems like the board is open to talks with Paramount. What's going on there? Are we in for another round of a bidding war when it comes to Warner Brothers' assets, JP?
Well, there's been some activist shareholders who have bought shares in Warner Brothers and put pressure on the board to start talking to Paramount again. And Paramount have actually adjusted their offer. Instead of just saying it's $30, they now will tick up every quarter to increase that for the time value of money. So that has made the board go back then and talk again to Paramount. No one knows what those discussions will be like. You can bet that Paramount is still trying to get their hands on Warner Brothers rather than lose out to Netflix, but they probably will need to sweeten the offer from the current $30 versus what Netflix has offered, which is a mix of cash and shares for everything, excluding the cable TV businesses that will be unbundled before the takeover that Netflix will try to close by taking over Warner Brothers. So yes, I think there's another chapter to be written here. Your downside is relatively limited. Your downside is if the regulatory authorities say that Netflix is not allowed to buy Warner Brothers because it will make them dominant in the streaming and TV content business. So there is some downside, but there's also upside if there's a sweetener from the likes of Paramount. So it's an interesting one to watch, and one to perhaps take a small stake in Warner Brothers in if you think that this is a bride and there's potentially two grooms they're going to fight over who's going to get the hand in marriage of this bride.
Yeah, and how are you viewing that deal, the ongoing talks at the moment, Ricus? And I think we don't talk about the regulatory side as much as we, talk about what's on the table when it comes to the offers. We do know that President Trump, of course, has ties with some of the CEO of Paramount, and how that's going to work when we're now looking at regulatory moves if Warner Brothers does go with Netflix.
I'm probably quite cynical, but that's my thoughts on the matter. Whomever pleases Trump the most will get the deal.
All right, let's move over to news out here at home. There's a question here around the property players. I'll give it to you, Ricus. With fundamentals positive for the sector, which counters would you be picking up at the moment?
Yeah, there's been a good recovery in that sector, specifically on the South African side of things. I think even the major players, whether it be Redefine, Growthpoint, Vukile, Resilient, to a certain extent, I think they're all looking pretty good at the moment. Growthpoint specifically, just from a price momentum point of view. So I'd be taking a look at that one.
What about you, JP? Bond yields also hitting record lows. That, of course, also working out in the benefit for the property counters.
Yes. No, I agree with Ricus. I think you can look at the major ones. Also helps with liquidity. But all the REITs, just about all the REITs, have re-rated quite strongly over the last year to 2 to 3 years. And if you add in the distributions as well, the total return has been very strong. So they still look okay, but I think the big move has happened over the last 3 years.
Yeah.
And from this point forward, you need to see, again, some positive economic growth, which would mean you have escalations that are still decent, at least in line with inflation, and you don't have negative reversions. Because with the increased strain we still see, whether it's retail properties or office properties, every time those leases come up for renewal, they take a big negative reversion. This has been the case now for a number of years. And you need to see a stop to that if you really want to see continued strong REIT share price performance, I would say.
Another counter that's quite reliant to, I guess, the economy and consumer spending in particular is Famous Brands. Your take on that counter, JP?
I like it. I've liked it for a while. I see the PIC also like it. They went through one of the 5% thresholds recently. I saw an announcement. Now, generally, I get nervous if the PIC is buying something. They are quite often a contra indicator, but I'm hopeful this time it's not the case. So no, I like Famous Brands, very cash generative business, being a franchisor. So they don't operate the stores themselves. There's a handful of stores they do operate, but mostly they franchise the stores. And the underlying franchisees have been under pressure.
Yeah.
But with deflation in food inputs, while still holding on to menu prices, hopefully some of that pressure can subside. So if the franchisees can be in a stronger position, that would put the franchisor also in a better position. And I think given the business model, I really like Famous Brands, and the shares are quite attractive in my opinion at the current price.
So Ricus, would you pick up some Famous Brands, or would you rather go get pizza at Debonairs?
I will never get pizza at Debonairs. Sorry, Debonairs. Look, I'm in Spur, so I'm biased, and I've been in Spur because I think operationally they've been executing better than Famous Brand, and certainly the prices held up better than Famous Brands. But still, as JP has said, at current prices, Famous Brands probably warrants a second look, specifically as if they can get some of their lagging, what the restaurants, if you want to call them that, to do a better performance. It's been a bit slapdash, you know, one section will do well, and then John Dory is not doing that well. So if you can get all those cylinders firing, then it's certainly not expensive at current prices.
Okay, I'll stick with you then, Ricus. Questions here coming through on Sappi. How long can Sappi go, and when will the short sellers stop pounding the stock?
Well, I don't know whether it's the short sellers pounding the stock. I think it's people just selling Sappi because the operational update wasn't great. They are in a difficult market space. I had a quick look at the graph. Downside to about 1350 very, very easily. And I'm not saying that because I think the company is executing terribly or anything like that. It's just, it's a bit similar to Afrimat. Management's doing what they can, but If you're sitting with oversupply, if you're sitting with continuous costs in looking after your plant and your product price is not moving in the right direction, you're in a difficult space.
And we're seeing the same sort of picture or trend playing out over at Mondi as well, right, JP?
Yes, so both Sasol and Mondi have been under pressure. I think Sasol is even in a worse position because it has more debt, and the strong rand is really bad for Sasol.
Do you mean Sappi?
For Sappi, rather.
Yes.
Seeing that they make most of their profits by exporting dissolving wood pulp out of South Africa. So the strong rand is really a headwind for Sappi. But Mondi as well. So different reasons, also different types of packaging. And again, Sappi is more dissolving wood pulp, which goes into the textile sector.
Yeah.
That's where they make most of their money, while Mondi makes most of their money through corrugated packaging, which is basically the boxes in which your home delivery comes in. So, these are commodity industries. They're cyclical industries. And when things get tough in these industries, you don't have pricing power. You don't have a competitive advantage. And if you have too much debt going into a downward cycle, like Sappi has had, then you get into real trouble. So I would stay away from both Mondi and Sappi, even at these depressed levels.
All right. Now, a question on Sasol. JP, with AI using a lot of energy and set to increase, what ETF is available on the JSE for an energy play? If not, what about Sasol? Will it benefit?
Gosh, I don't think there are any energy ETFs on the JSE. I'm pretty sure there are in the US. These days, there's an ETF for absolutely anything and everything in the US. To play Sasol because of AI's energy demand, I think is maybe a bridge too far. Sasol has got significant chemical exposure, and it has very specific exposure to the South African energy space. We don't have that many data centers in South Africa. I know in SONA it was announced that we will get a few more data centers in South Africa, but it's not really going to move the needle in terms of energy use. And it's more a boon for Eskom if they can get their act together rather than Sasol. Yeah. So with a lot of headwinds, a lot of problems, yes, maybe they get a relief with carbon tax being pushed out a little bit. Gosh, I think the terminal value of Sasol is close to zero. It is very, very cheap, but in my mind, it's a classical value trap.
All right. We have to get into stock picks. Ricus, let's get your pick for the day. Where are you seeing value at the moment?
Deutsche Telekom and don't be fooled by the name. They make about 60% of their profits in the US through T-Mobile. Last time we were up with JP, I mentioned that I suspect there's a revival in the Rust Belt in the Midwest in America because of various reasons.
Yeah.
T-Mobile is exposed to that rural area, which has been economically depressed for a very long time, in that they provide fast 5G services above Verizon and AT&T. I can see, in other words, that's an interesting earnings growth trajectory or vector for Deutsche Telekom. I'd like to see what the results are doing on the 26th of Feb, if I'm not mistaken, but I think price-wise, probably upside to about 35, 36 euro from 33 euro at the moment.
Let's get your pick then, JP. What are you hanging your hat on this evening?
I'm picking a Dutch company called Adyen. It's a payment technology provider. So basically it allows merchants or businesses to accept payments, credit card payments, and all kinds of electronic payments. It's one of the major players in the global payment space. The share price took a huge knock in the past week or so because of results that were just so-so. The expectations were too high, and the guidance looking forward was also a little bit disappointing. But they're still growing very strongly. People are concerned what AI might do to software and payments. I don't think the payment space is going to be affected as badly as some software providers. So with a leading position in payments, they've got banking licenses in Europe and across multiple other countries, rolling out their payment solution to more and more merchants. and taking a fee every time a payment is accepted, I think they'll continue growing, and the valuation now is a lot more attractive after for a very long while it was quite expensive because of this high growth.
Okay.
So with the recent disappointment in earnings, I think for the first time in a long time, Adyen is trading at an attractive level.
All right, let's leave it there, gents. Thank you so much for your time and sharing your insights with us this evening. That's all for Stockwatch today. Thanks to my guests, Jean Pierre Verster from Protea Capital Management and Ricus from PSG Hole-in-One Ruimsig. Up next, it's The Close.